What's up everyone, it's Scotty with Money Investing. In today's video, we are going to be talking about Zoom, ticker symbol ZM. A lot of you guys have been asking questions about this company and does it have a future? Does it have any hope left for us to see a recovery, because it has underperformed for the last couple of years. It is still underperforming in this year, even though technology has done really well in 2023. And yet we continue to see Zoom pretty much trading at its 52-week lows. So in this video, I'm going to break down everything you need to know. We're going to talk a little bit about the fundamentals, the intrinsic value calculation, the expected earnings, which they are going to release on Monday after the markets close. So all that's going to be talked about in this video. Make sure that you drop a like, subscribe to the channel. There is a 16% annual discount available till the end of this month that you can take advantage of. You can, of course, get access to all the alerts, members-only videos, and, of course, intrinsic value spreadsheets and a lot of other benefits as well. So links are going to be down below. So this right here is going to be Zoom's revenues, right? So we already know that Zoom's revenue absolutely went parabolic during the pandemic, right? And Zoom was one of the biggest beneficiaries of the pandemic. As messed up as it sounds, the COVID-19 pandemic was one of the best things that happened to Zoom, because everybody pretty much went onto their platform for doing meetings, business meetings, schoolwork, education, everything kind of moved online, work from home, and Zoom was the only way to connect with people virtually. And of course, the revenues went from $622 million to over $2.6 billion to over $4 billion. And now you'll notice the growth rate has slowed down. So it's now more stagnating a little bit. That's actually a good thing versus something like a Zim Integrated Shipping or Upstart, for example. All these companies that I just mentioned, Zim, Upstart, they benefited hugely from whatever happened during the pandemic, but then they normalized back down. So revenues started collapsing back lower. Zim reported their numbers and it was brutal. Upstart's going through the same thing. But Zoom has been able to maintain, right? It's not really going down. It's not so much so that the revenue growth rate, of course, is decelerating, but it's not going down. It's still at 4.4 billion, trailing 12 months at 4.4 billion. So that's a pretty nice baseline for Zoom. If you take a look at gross profit, they have also stagnated sideways at 3 billion, 3.2, 3.3. So the growth rate, again, is not as aggressive. So it's trading sideways. And operating income is perhaps one of the reasons why the stock price is down substantially, because it is lower from about $1 billion to $245 million to $68 million because of massive amounts of SG&A. And of course, R&D expense that has also more than doubled pretty much every single year. So what we have really seen is Zoom's inability to really predict what type of growth rate they're going to see. And of course, they spent a lot of money on marketing, they spent a lot of money on R&D, and now the growth rate's stagnating. So revenue is not obviously doubling from here, but guess what? R&D is, SG&A is, so those expenses are piling up and revenue is not growing as fast enough. So operating income obviously has come down substantially, and as a result, net income has also come down from 1.3 billion, 203 million to 5.5 million. So substantially lower profitability, and shares outstanding have also gone substantially higher with, of course, diluted EPS now coming down substantially down to pretty much break even at this point. Now, margins are still solid at 75% gross margins. That is the 5-year average for the company. Net income margins have come down substantially, pretty much flat on the year. Free cash flow margins at 35%. Return on capital assets and equity is lower because of that lower net income in the first place. And this right here is going to be the balance sheet. Now, perhaps the only thing that's going for Zoom is that they've got a ton of cash. A ton. $5.6 billion of cash is on their balance sheet, with literally pennies in debt. This is chunk change. $91 million in debt is peanuts compared to their $5.6 billion of cash chest. So net debt is negative at 5.5 billion. Very strong current ratio, very strong quick ratio. Debt to free cash flow under 1.3. So they can't go bankrupt regardless of what anyone tells you. Zoom is not going bankrupt anytime soon. Of course, if they don't manage this position well, if they take on too much debt and kind of deplete that cash reserves, maybe we get to a point in the future where there's going to be vulnerability or threat to bankruptcy. Right now, it's not. They've got plenty of cash and they will just not go bankrupt. And the thing is, watch this number, 5.5 billion. The moment Zoom trades at $5 billion, I will be loading the boat for Zoom with a lot of shares. That would be a price which would be a no-brainer because we talk about this net liquidation value, and Zoom would pretty much be trading at or below their net liquidation value, which would be a no-brainer buy at that point. Like, it would not make sense. It would literally not make sense for Zoom to be trading below its net liquidation value. And if it ends up trading below $5 billion, which obviously is going to take a lot of time because Zoom right now is a $19.7 billion company. So in order for us to get down to $5 billion, it would need to drop another 75%, and we're looking at $16, $17. So got a long way to go. It's not going to happen anytime soon, but just something to keep in mind. If it ever ends up trading at $5 billion and it still has that net debt, it's going to be a no-brainer. This right here is the valuation. So speaking of, again, non-GAAP numbers, we're still trading at pretty low non-GAAP earnings multiple. By the way, I do want to mention that I think there is some GAAP adjustments to the net income as well. Without the GAAP adjustments of non-GAAP numbers, net income is actually much better than what it's suggested to be over the last couple of years. It's been coming down, but that's also because of that GAAP adjustment. So non-GAAP numbers are far better than what the GAAP numbers suggest them to be. Enterprise value to EBITDA, 8 is the level of price to sales a little bit over 4, and price to cash flow over 13 to 16 times is where we're trading at the moment. Earnings expectations are modest, very, very slow growth in the range of 7 to 8% for EPS. And this right here is going to be that upcoming earnings expectations. Again, August 21st, after the markets close, $1.06 per share. And revenues of $1.1 billion is what the market's expecting. Now, going over to the actual intrinsic value spreadsheet, what you will notice is 7 to 8% CAGR. So 2024, $4.32, 2029, $6.11, and 2033, $9.28. So this right here is going to be that compounded annual growth rate for Zoom. And of course, the share dilution has been pretty substantial. So we're not going to be using 27% because more recently, though, it's been a little bit more stable. So if you come back, you'll notice that they've gone from like 233 million shares in 2020 to exactly where we are right now. So let's just do 254.3. So 254.3, that's going to be since 2020. And that's about a 6% growth rate in the last 3 years. So I'm going to plug in 5% share dilution here. We're going to go with 7% growth rate. We're going to go with about a 14 times PE multiple, 12% discount rate, 10% margin of safety, and we get down to a fair value of just under $34, and the price right now is at 66. So obviously it needs a little bit more downside here, considering that the fair value is so much lower than where the market price is. But this right here is a very strong area of demand. I mean, it's been validating this level for weeks, for months, even last year. It pretty much was trading at those levels before having this parabolic run higher. So very strong support at $60. That's going to be an area of support to watch. But then, of course, the lower it gets, the better the risk profile becomes. And resistance is going to be that lower high for Zoom moving forward, with resistance all the way up to $90 per share. So that's going to be the entire analysis on Zoom for me. The moat is the real question. The question is the relevance, right? I mean, do they have a significant moat strong enough to be relevant long-term against the likes of Google Hangouts, Microsoft Teams, Apple Links, all these different services that are offered by other big tech companies for free? Can they be relevant enough? Do they have the moat to survive in this competitive landscape? And of course, at the same time, basically continue to grow their business and keep the balance sheet as strong as it is, and offer some type of valuation deal. So that's going to be the analysis. Hope you guys enjoyed this video, found it helpful. Let me know your thoughts down in the comment section below. For me, it's going to be a pass at this point. I am going to be waiting for better and better deals on Zoom, but the balance sheets are very strong, so there's no bankruptcy risk, at least not at the moment in the short term. So that's something to keep in mind as well. Make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.